Let's see if I can pick the live stream from there. Okay. I think it is up now. Got it. I think it is up. All right. Okay, so
thousands of people from around the world are using this 6-second loophole before bed to reverse type 2 diabetes, all from the comfort of their own homes and without prescription medication.
Sorry about that. I think my stream is picking some feed. Okay, let's go. Okay, so I'm going to share my screen and then we will jump straight up into the discussion. I see some of you guys joining on YouTube. I'm going to be taking your comments down here. So if there are any questions you have, you put them in the comment section for me, and I'm going to be answering all your questions for you as we begin the journey on management accounting. So let me share my screen and let's really get excited about the discussion. Let's see, coming up. Okay. So my screen is up there. So management accounting. Let's see what we're going to be able to do. Management accounting. Now, like I mentioned, in the next 12 weeks, we're going to be running through the management accounting syllabus to find out the various things that we need to look out for in order for us to pass the examination. Now, before I get excited to take you through the various things that we need to understand about the entire syllabus, let me share my thoughts quickly with you on the management accounting exams, and then mention some things that you need to be aware of in order for you to really understand and pass the examination. Take note that the management accounting is going to be, as you are aware of, 5 questions compulsory coming in that you need to answer. Now, the questions are going to be covering various scopes of the syllabus that you need to pay attention to. However, depending on how excited the examiner is, and then the structure of the exams that the examiner wants to adopt in a given period and review, what we're going to be seeing mostly is that the exam could be either a 65-35 or better still 60-40. Now, when we say 65-35 or 60-40, we mean 60% of the questions coming in relating to issues about computations. Okay, so computation or calculation questions. Then we're going to have about 40% also on rating or comment questions. Rating or comment questions. Now, your problem as a whole in management accounting and your inability to pass the management accounting will be based on a number of factors. And that is what I want you to make sure you pay attention to as we run through the next 12 weeks in order for you to pass the examination. Number 1 is understanding basic principles. And that is what we're going to be doing today. That is where we're going to open the lecture with today. Understanding basic principles. In management accounting, there are certain basic principles that you need to be aware of that you must understand. Your failure or your inability to understand these basic principles will mean you may not be able to pass the examination. So you need to make sure you understand these basic principles that we'll get ourselves into in a moment. Number 2. To excel in the management accounting exams, you need to make sure that not only do you understand the basic principle, but you have a deep comprehension of the question structure. Now, please take care of this very well. Now, what I mean by deep comprehension of the question structure in this particular case is that, you see, the management accounting exams, it's going to be based on English. I mean, you know, it's an English exam already, but then your ability to understand the requirements of the question, and then your ability to understand the nature of the question and your ability to be able to interpret the question is crucial for you to pass the examination. So not only are you expected to have or understand the basic principles that relates to management accounting, you must have a deep comprehension of the question structure that the examiner is going to be bringing. When you read a question, you must know the requirements that the examiner is asking you about. When you read a question, you must be able to understand the nature of the question. When you read a question, you must be able to interpret the question very well, because failure to interpret a question very well will mean that definitely or certainly you're not going to be able to answer the question at the end of the day. So the takeaways I want you to have is this: the number one, to pass the management accounting exams, we need a deeper, we need an understanding of the basic principles. Number two, we need to have a deep comprehension of the question structure. Very important. I cannot overemphasize the importance of that. The third thing that I want you to make sure you have an understanding on as we begin this journey is to deal with issues relating to grammar, handwriting. Now, there are certain questions like short-term decisions. Questions relating to short-term decisions. Questions relating to budgeting. Questions relating to variance analysis. That requires a certain level of understanding. So if you are somebody who is not careful about reading the question and understanding the question, the grammar in the question, you're going to fail the exams. So it's not just about, oh, yeah, I'm good, I understand the principle. It's not just about, oh, I know the nature of the questions. No. You must go beyond that. When there is a short-term decision question, the nature of the question is going to be in a certain way that when you read it, you must have a certain comprehension. You must have a certain understanding. And throughout this lesson, we're going to be trying as much as possible to bring some of these things to bear. Then as you are writing your answers out, your handwriting is going to be crucial. The chief examiner has complained a couple of times relating to the handwriting of students. As I mentioned earlier, our exams may be 40% or 35% comment or written aspect, which means your handwriting has to be something that you need to be mindful on as you go into the exam hall. So about management accounting, this is the total thing that you need to understand relating to management accounting. Make sure you understand the key principle, have a deep comprehension of the question structure, and make sure that your handwriting and your grammar, you work on that pretty well. Now, certainly, the last thing is you make sure that you practice a lot of questions. That is going to be important. You practice a lot of questions, because the more exposure you have relating to questions, the more you can position yourself strategically to pass the examination. So if you expose yourself to a lot of questions, then you will be able to increase your chances of passing the examination. If there are any questions you have, you raise your hand and I bring you up, or you put it in the chat for me and I will answer any questions that you're having or anything that you want me to share my thought on. So basically, that is what I want to share with you on the management accounting as we begin the journey. It's a technical paper. When I say it's a technical paper, it means that the pass mark for this paper, I always say, is far below 30%, far below 30%. Far below 30%. It means that you put 10 people down, maybe only 2 of them will pass the exams. Technically, like 20%. So the pass mark for management accounting is really low. Now, that doesn't mean that you should fail the exams, but it means you need to pay a better attention to this paper as we prepare for it in that case. So that is the idea about management accounting that I want to share my thoughts with you on before we get excited about our discussion. Okay. So now that we've gotten that out of the way, we've told the stories out of the way, let's get excited about introduction to management accounting. Now, I'm going to go straight up into my discussion and share my thoughts on various issues. I believe that you have downloaded the ebook for management accounting. In case you've not downloaded it, it's under the first video when you open the course. So when you open the course, the very first video in management accounting, you'll be able to download this ebook. It is 119 pages. A lot of the discussions we will be having will be coming from this ebook, and has a lot of things that you need to understand and pay attention to. So in case you've not downloaded that, you can download it under the first video when you open the course. Now, the role of the management accountant in a company is very crucial. It has been debated that the management accountant has a different role from the financial accountant. Yes, definitely, because the financial accountant is statutory. Okay, it's required by law that we prepare financial statements. And so since it is required by law that we prepare financial statements, it means we need to keep a financial accountant available because he's the one who will do the double entry and keep the records and all that. But management accounting, there is no law that requires that you should have a management accountant as a company or we should have a management accountant as a company. For that reason, management accounting is more of optional thing. So there is an argument that comes up every time that says that, okay, if we are not statutorily required to have management accountants, then there is no need for us to even employ anybody as management accountants, because I mean, if anything, we would just be paying their salaries and they are not adding any value to us. But that is not true. Why? Because there are various roles that a management accountant plays, which is the key or the pillars, or which becomes the pillars for our discussion in the next 12 weeks. So the roles of the management accountant. Among other things, the management accountant role can be divided into a number of points that I've written out here. And this is the topic or the syllabus structure of your management accounting exams. One is the determination of cost. One is the determination of cost. The management accountant's role in the organization is to determine the cost that we incur in the production of goods and services. That is crucial. That is the first thing. We're going to be getting into that in a moment, so don't worry. But after we determine the cost we incur on the product, the company must sell the product at a profit. So the management accountant must also, or is also the one who helps the company in setting what? The price for the product. So pricing decision is also another role that a management accountant plays. This is where we're going to be sharing our thoughts on the concept of markup and then margin. When we get there, we'll discuss that. Simply, markup is on cost, margin is on sales. Don't worry, we'll get into that later on. But that is a key role that a management accountant plays, pricing decisions. 3, the management accountant keenly also helps the company in budgeting, because budgeting is fundamental to every company. So the company must plan how much it wants to, how much cost it intends to incur in the period under review, or how much cost it intends, how much revenue it intends to raise in the period under review. So budgeting is going to be a crucial thing that we're going to be looking out for. We're going to be looking at how we look at the functional budget, that is the preparation of the budget for the various departments. Then we're going to share our thoughts also on what we call the master budget. That is the cash budget, the budgeted income statement, and the budgeted statement of financial position. We're going to share our thoughts on that later on. It's a key role that the management accountant plays. Not only that, one of the important roles of the management accountant is also cost reduction techniques, and we'll get into that also in a moment. How do we reduce our cost? And most importantly, cost control. The distinction between these two is that cost reduction is not routine. It's a one-off thing that a company does. We'll get into this, don't worry. But then cost control is a routine activity, something that a company does every time in a regular interval to help the company to maintain or keep costs at an acceptable or at acceptable levels in the period under review. So cost control, cost reduction, very important. But we need to also assess an organization's performance and to see whether the company is doing well or not. Now, note that the financial accountants can do this for us, but then the management accountants bring another expert or another knowledge that we must know about. Hence, we are going to be also looking at performance measurement. There are modules of evaluation that I'll be sharing our thoughts on pretty later on in our discussion. But some of the modules of evaluation, which the examiner is going to be bringing some questions around them, include issues such as the activity-based costing, activity-based costing. Two, we're going to be looking at issues that relates to balanced scorecard. We're going to be looking at issues such as just-in-time system. We will spend some time to look at issues relating to total quality management. Very crucial. It's primary. We're going to be spending some time to look at all these things: activity-based costing, the balance scorecard, the just-in-time system. We have also issues about cost reduction and cost control. We will look at that also. Throughput accounting. It's also another model of evaluation. We're going to be sharing some thoughts on that. Business process reengineering is also a method of evaluation. There are a lot of them. We will get into all of these later on in our discussion, but we will look at these models of evaluation and how they are used by organizations in order to measure the organization's performance and also set various standards for the organization to achieve its objective. So again, the role of the management accountant is to help us to evaluate the organization's performance, but also help us in variance analysis, another key topic that we're going to be spending our time on later on. Then many companies have various divisions. In other words, they don't produce or they don't do the thing as just one company unit or one entity unit. They have more than one division. So how do we assess the performance of each divisional manager, pay them their salaries, and ensure that they are doing what it is that they expect or they are expected to do? So we'll look at divisional performance evaluation as well later on in our discussion. Then organizational performance appraisal, where we look at the organization as a whole, their performance for the period and review. So the management accountant helps us to determine the cost of the product, helps us in the pricing decision, helps us in cost reduction, cost control, helps the organization in performance measurement. Then other short-term decisions that a company is going to be making. This is a huge aspect that we are going to also spending some time on, other short-term decisions that a company makes. Now, these short-term decisions could include issues such as make or buy. That is, should we produce a product in-house or purchase it from outside? Okay, so should we produce a product in-house or purchase outside? Make or buy, we will look at that. Number two, limiting factor analysis. It's a short-term decision making. Organizations have limited resources. Now, it's not that the resources are not available, but sometimes they are available, the entity cannot afford it, or they are not available at all. So when resources are limited, we are limited on material. Okay, we are limited on labor. We are limited on machine capacity or machine hours. How do we use those limited resources to still maximize the profits of the organization. That is the concept of limiting factor analysis. And we're going to be getting into that pretty later on in our discussion. Then relevant cost analysis. Relevant cost analysis. Now, the idea about relevant cost analysis is to help the company to make one-off contract decisions. So, for instance, let's say we are a bread baking, or we are a bread baking company, and so someone comes and place an order for us to bake bread for him or her because it is his birthday, and so as part of the things that he's sharing, he wants to share bread, and he wants the bread to be branded with his pictures and everything. If such a contract comes, how do we charge the person? Or let's say we are an event organizing company, and an artist has come to us and say, hold this event for me. How much do we charge that artist at the end of the day? Those are one-off contracts. We must use relevant costing principles and to be able to determine the price that we will charge the person. So we will get into that also later on. Then the examiner's favorite, break-even analysis. Break-even analysis. Okay, is the examiner's favorite. It's also called cost volume analysis. That's another short-term decision that we're going to be looking out for. It's the examiner's favorite. He has brought it over and over again, something that we're going to be looking out for. Then we have outsourcing decision. This is a reading aspect technically that we're going to be looking out for later on as well under short-term decisions. Now, the reason I'm listing these things out to you is for you to start studying and going ahead of me, because lecture videos on all the things that I'm mentioning are already available on the portal. So you could go ahead of me and prepare well, because you know exactly what topics you are supposed to cover, what areas you are supposed to cover to increase your chances of passing the examination. The fun part is that when it comes to the issue about short-term decisions, it's just only one of them or two of them will drop, but there are a lot of things under short-term decisions. So these are some of the things we will look at. Then pricing decision is also actually here, even though I singled it out. Pricing decision is also sometimes here under short-term decision. So there are a lot of things here. We're going to be looking at them there. But that is also another role of the management accountant. He helps the company in order to make these short-term decisions. Then finally, investment appraisals. Companies are going to appraise a lot of investments because they will undertake capital investment all the time. So the CFO can do that though, but then the management accountant also must have some knowledge when it comes to project appraisal. So we're going to be looking at the concept of the capital budgeting process. We'll look at the concept of capital budgeting process. What are the processes involved in appraising a project? Then we'll look at the various methods of appraisal. We'll spend time to look at the various ones. We have the accounting rate of return. We have the payback period. We have the discounted payback period. We have the net present value. Then we have the internal rate of return. And we're going to be spending time to look at all of these things to see exactly what we have to do in that particular case. So when we talk about the role of the management accountant, these are the role of the management accountant. And these are the things that our syllabus requires us to know as we go into the exam hall in the ICAG August 2022 examination. So in the next 12 weeks, our discussion will be centering around these 8 things that I've listed down here, 2, 4, 6, 8 that I've listed down here in the next 12 weeks so that we can prepare to pass the examination. Any questions, please? If you have any questions, you raise your hand, I bring you up, or you put it in the chat for me. For those of you joining us on YouTube, you put your questions in the chat. I'm going to read all your comments and provide you with some answers there. Okay, so let's go. Seeing some comments coming in on YouTube, let me pick them quickly. Ibrahim Adamu said, "Sir, I'm sorry. I have a problem of question. I need your number, please." My timing doesn't allow me to solve questions for people, so I don't do that. If there is a question you want me to look at, I'm sorry, I will not be able to do that. Ali Koroma said, "Hi bro, do you have lectures on CVP? You can check our channel. We have a lecture video on that." Isaac Norte Okwan said, "Please, I have paid for corporate reporting. Please, is there any WhatsApp platform so I can join?" Yes, you send hi to us on WhatsApp on our Vodafone line, and you will be added to our group. Okay, so let's go. If there are no questions. So let's begin the journey. Now, I told you something. Yes, David.
Sir, please, I wanted to ask whether in terms of please, can you hear me?
Yeah, go.
Please, I wanted to ask whether in terms of the investment appraisal, is it the same, similar to the financial management? I know we are doing management accounting. I want to ask whether it is similar or it is different from the financial management, those who did financial management, or is the same principle?
Yeah, it's the same issue. There is nothing here. If you are doing capital budgeting process, it's the same thing as financial management. If you are doing MPV, ARR, all that is the same thing. So it's the same thing.
Okay, sir.
All right. So remember, I told you something in my introduction that there are certain principles that you must understand. So in today's lecture and in the next 2 hours, 20 minutes, we are going to deal with the fundamental principles you must understand in management accounting to increase your chances of passing the examination. Now, I'm going to leave the definitions of certain things out to let you read that in your book, in the ebook, so that I handle the bigger stuffs. Okay, so that I handle the bigger stuff. So in your ebook, you can read the definition of management accounting. I don't have time to go through that. The definition of cost accounting, you can go through all that. I'm going to handle the key issues so you can read those things in your ebook. So let's begin the journey. So our concept is management accounting. But the first thing we mentioned that the management accounting does is determination of cost. Okay, so if the first role the management accountant plays is the determination of cost, then the question we ask ourselves is, what is cost? What is cost? So we're going to explain the concept of cost in the next few minutes, and then expand on it, solve some questions. So please stay with me carefully because we've begun the journey. So when we say cost, what the heck is that? What is cost? Any ideas? When we say cost, what do we mean by that? What is cost? Yes, when I say it costs me, yes, Abeku.
Cost is said to be the amount of expenditure attributable to a product, a service, or a job.
Okay. The amount of expenditure attributable to a service, a process, or a job. Yeah, that is it about that. That is good there. So that is cost. That is cost. So it refers to the amount of expenditure. Okay. It refers to the amount of expenditure. It refers to the amount of expenditure incurred on an activity, a process, or an undertaking. Or an undertaking. So that is cost. That is cost. So in a simple language, we say that it refers to the amount of expenditure incurred on an activity, a process, or an undertaking. But if someone says, hey, okay, so let's say that I am a furniture, we have a furniture company, okay? Let's say we have a furniture company. So let's say that we say that to manufacture each furniture, the cost we incur is whatever, let's say $1,000. So to manufacture a furniture, the cost we incur is $1,000. So the question we ask ourselves is, what is the meaning of that? Because when you say, oh, I incur a cost of $1,000, what are the elements of the cost? What are the composition of the cost? What are the things that are entailed in the cost? We will get into that. But before we get excited, there are some key terminologies that relates to cost that we need to understand. So let's look at some key terminologies that relates to cost. So some key terminologies that relates to cost. One, cost center. So we're going to look at cost center, cost unit, unit cost, profit center, responsibility center. So cost center, cost unit, unit cost, responsibility center. So let's take the one-liner of this. What is a cost center? What is a cost unit? What is a unit cost? What is a profit center? What is a responsibility center? Any ideas? One-liner. Cost center. What is a cost center? And what is the example of it? What is a cost unit? What is an example of it? What is a unit cost? What's an example of it? What is a profit center? What's a responsibility center? Any ideas? These are, yes, Oxbert.
Yeah, cost center is a department at which costs to be ascertained.
A department?
A department at which costs to be ascertained.
A department at which cost may be ascertained. Okay. Okay. All right. Okay. So Oxbert is saying that a cost center is a department at which cost may be ascertained. All right. Any other ideas? Who again can lie? Let's continue. Because Oxbert's definition is not that strong, but I mean, it's there. It's not there like that, but we'll pick it like that. We'll pick it like that. So yes, Abdullah. Yeah, Abdullah, your hand is up.
It is a center in an organization or a section where costs can be traced.
Okay, a center or a section within the
an
organization to which costs may be ascertained. Okay, yes. Okay. So you're defining the word, but you are bringing the word inside. Okay, we like it. That's fine. Okay. George said it can also be a location, person, or a place. Okay. Okay, location, person, or a place. So in a simple language, one-liner definition, we say that cost center refers to a department, an item of equipment, group of people, or a location to which cost may be ascertained. To which cost may be ascertained. So that is cost center. It refers to a department, an item of equipment, group of people, a location to which cost may be ascertained. Now, I'm going to come back to that in a moment. Then we go to cost unit. When we say cost unit, it refers to the quantitative unit of a product. It refers to the quantitative unit of a product to which cost may be ascertained. To which cost may be ascertained. Now, stay with me carefully here as we dive deeper into this. So when we say a cost center, it could be a department of an organization. Okay, so the sales department can be a cost center. Okay, the production department can be a cost center. Okay, our plants and equipment can be a cost center because we said item of equipment. But when we say cost unit, we are referring to a quantitative unit of the product. So example of this could be a bar of soap. Okay, a bar of soap. A bar of soap. That can be a cost unit. Okay, or a tin of milk. That can be a cost unit. So what does that mean? When we take our organization as a whole, the departments that produce the product can refer to as what? A cost center. The machine we use to manufacture the soap can be a cost center. But a bar of soap, not a box, just a bar of soap can be referred to as what? A cost unit. Are you getting it? So cost unit is the quantitative unit of a product to which cost may be ascertained. Now, you will see the value of these things later on. So let's continue. 3, unit cost. So you make sure that you don't interchange cost unit with unit cost. As the name suggests, unit cost means the cost of a single unit of output. Okay, so it refers to the cost of a single unit of output. It refers to the cost of a single unit of output. That is a unit cost. A unit cost. A unit cost. Then we come to the next one. We said profit center. Now, we also have revenue center and all those things. But then a profit center is simply a location, a division, or a segment of an organization responsible for both revenue and cost. Okay, so it is a cost center with the ability to generate revenue. With the ability to generate revenue. In other words, for instance, a branch of a company can be a profit center because they will incur costs. Okay, they will incur costs and at the same time earn revenue. So they become what? A profit center. They become a profit center. We also have what we call investment center. Now, all of these terminologies, you can see them as well in your ebook. If you go down to the terminologies here, I wanted to see if it is. Okay, it's in the terminologies there. You could see them there. Then the last one that I want to share my thought on is the responsibility center. Now, we will use this under performance measurement divisionalization. So when we get there, we will be using responsibility center. But it is simply a cost center with a designated divisional manager. Okay, it refers to a cost center with a designated or appointed divisional manager. So we'll be using responsibility centers more later on when we are dealing with the issue about divisional performance measurement. But these are a couple of terminologies that we need to just keep ourselves on our mind on as we begin, because we're going to be using these terminologies later on in our discussion. So that is cost, the amount of expenditure we incur on an activity, a process, or an undertaking. But I asked a question before I came to the terminologies. I said, if you're a furniture manufacturing company, If there are any questions, please you raise your hand and then I bring you up, or you put it in the chat for me, okay? If there is something you don't get, you raise your hand, I bring you up, or you put it in the chat for me so that you don't shovel it down. So let's see. I asked a question. Let's say we are a furniture company, and to manufacture a furniture, we spend whatever, $1,000. So the question we ask ourselves is, what does this $1,000 entails? And that is what leads us to one fundamental thing that will set the tone for us in the next 2 hours, and that will be cost classification. Cost classification. Cost classification. So what is cost classification? Like the name suggests, it refers to the grouping of cost based on certain characteristics. It refers to grouping of costs based on certain characteristics. We are not excited about that, but then the basis of cost classification is what we are excited about. So please stay with me, because this is where the journey begins to become interesting. We can classify costs according to nature. So by nature, we can classify costs according to function. We can classify costs according to controllability. We can classify costs according to whether it relates to production or non-production. Really, our focus will be on the first two, nature and function, because controllability and production will come naturally as we begin to dive into the discussion. It will come naturally as we begin to dive into the question. So let's look at classification of cost by nature. What is classification of cost by nature? Simple. Classification of cost by nature simply means classifying cost according to the element of cost. So it refers to the classification of cost according to the elements of cost. Classification of cost according to the elements of cost. Now, there are 3 elements of cost. There are 3 elements of cost. We have what we refer to as material cost, labor cost, and expenses. Material cost, labor cost, and expenses. Now, stay with me carefully, because we're going to be expanding on each of these in a moment with practice questions. So when we say material cost, what do we mean? Material cost simply can be defined as the cost of ingredients or inputs, the cost of ingredients or inputs used in the production of goods and services. The cost of ingredients or inputs used in the production of goods and services. That is the first thing. That is the first thing. So if I go back to my furniture company, then all the materials we used could be the wood, the nail, the sandpaper, the glue. All those can be referred to as what? The material cost. All those can be referred to as the material cost. So that is the first aspect of our discussion, material cost. But you got to be careful here. Material cost can further be divided into two. Material cost can further be divided into two. We have what we refer to as direct material cost and indirect material cost. And indirect material cost. We're going to expand on these in a moment, don't worry, so that you will see what they are generally at the end of the day. Give me a moment. I'm having some people trying to join my meeting from somewhere. I don't even know. Who is that? I don't even know the name. Okay, let's go. So material cost can be direct or indirect. We're going to expand on that in a moment. Then we come to labor cost. Labor cost, on the other hand, can be defined as the cost of human efforts, the cost of human efforts used in the production of goods and services. Used in the production of goods and services. Again, this can also be divided into direct labor costs and then indirect labor costs. We'll get into that in a moment, so just stay with me. Then the last one is expenses. Expenses. In a simple language, we say that expenses are all other costs incurred in the production of goods and services, apart from material and labor. Apart from material or labor. So for instance, maybe we hire a special machine. The cost we incur in the hire of that special machine is an expenses. So if I go back to my furniture illustration, stay with me carefully. If I go back with my furniture illustration, you know, when you are, okay, maybe you may not know, but when furnitures are being, when a furniture is being manufactured or fabricated, or depending on whatever term that is used, there are certain machines that are used to provide the furniture with a certain style, a certain nature that we have. So if we hire any machine such that, the cost we incur will be referred to as what? Expenses. We'll expand on that later on, don't worry. Then maybe we hire a specialist. Hire of specialist to check the quality of our furniture. The money we pay to the person is an expense. Just recently, I heard that there is even a profession called, how do we call it? Organizers. There are people called like organizers. Like if your home is not organized well, you can call these people and they will come to your home and come and organize everything for you very well. I didn't know that was even a big industry, and people earn millions of dollars just being organizers. So hiring special or a specialist to deal with, to check the quality of our thing or do something specific relating to the product we are manufacturing is also what? An expenses that we incur. Transportation cost will be an expenses. Okay. Electricity will be an expenses. Rent will be an expenses. Okay. Rent could be an expenses. All right. Then issues relating to maybe other things that we incur on will all be there in that case. Now, the sweet spot here is that the high of special machine, the high of the specialist, these are direct expenses. Stay with me carefully. These are direct expenses. Whilst issues like the manufacturing, the transportation costs, the electricity, the rent, they can be referred to as indirect expenses. Indirect expenses. So let's go back. We are saying that there is material cost. There is material cost. Now, the material costs are the ingredients, the inputs we are using in the production of goods and services. And we are saying that there is a direct material cost. So if I come back to my furniture business, for instance, the direct material cost here will be maybe the cost of the wood that we are using. Is a direct material cost. Because, and I'm going to explain why it's a direct material cost in a moment, will be a direct material cost. When it comes to labor, the carpenter who is dealing with a chair could be a direct labor cost, whilst his apprentice will be an indirect labor cost. And then we're going to be explaining all of those things in a moment. So these are the three elements of cost: material cost, labor cost, and then expenses. But this is where the journey becomes interesting. The question we need to ask ourselves is, hey, what is the difference between direct costs and indirect cost? So let's share some thoughts on the differences between direct cost and indirect cost. Direct cost and indirect cost. So direct costs and indirect cost. So when we say a cost is direct, it simply means that it can be traced. It can be traced or allocated to a particular cost center or cost unit. It can be traced or allocated to a particular cost center or cost unit. Remember, we defined the terminology. What is a cost center? What is a cost unit a moment ago? Here we are. So when we say a cost is direct, it can be traced. So look at it. Why are we saying that the high of the special machine is a direct cost? The high of the special machine is a direct cost because we can trace the special machine to the furniture we constructed or we manufactured. We can trace the money we gave to the furniture specialist who tested the quality of the furniture to the furniture that we are manufacturing as a company. That is why it is a direct cost, because it can be traced, it can be allocated to a particular cost center or cost unit. But indirect costs are not like that. So these ones cannot be traced, then it follows to a particular cost center or cost unit. You finish the sentence. Cannot be traced to a particular cost center or cost unit. That's the first distinction between the two. The second thing is the summation of them. The summation of the direct cost results into a prime cost. So the summation of direct cost gives prime cost. Gives prime cost. Again, that is crucial for us. We will use that knowledge in variance analysis. We will use it in budgeting. We will use it in special or short-term decision making. So it's going to be something that we need to make sure we know very well in that particular case. So that is the issue there, that it can what? The summation of that gives a prime cost. It means direct material cost, direct material costs, and direct material costs plus direct labor costs plus direct expenses give us the prime cost. Gives us the prime cost. Okay. But then the summation of indirect costs gives us overheads. Okay. The summation of indirect cost gives overheads. So when we say overheads, we mean indirect material cost, indirect labor cost, indirect overheads. Indirect overheads. So that is the second distinction between the two. This is what leads us to what we call the cost card or the cost sheet. So if we are preparing a cost card or a cost sheet, we are going to be slashing in our currency sign and we'll bring in the direct material cost. We'll bring in the direct labor cost. We'll bring in the direct expenses. When we add these up, they give us the prime cost. Then we will add the factory overheads. Now the factory overheads will be added, which we will do workings for. Don't worry, I'll explain that to you later on. And that will give us the factory or production cost. Then we will add non-production overheads. And that gives us the total cost. Then we may have to add our profit, which may be a profit markup or a profit margin. I'm going to explain that to you later on. And that will give us the selling price. So this is how we prepare the cost card. Give me a moment. Let me set up a light here. I just got doom source. So let me set up a light here. Okay, we're good. Let's go. So this is our cost card. So it is from this principle of the fact that summation of direct cost gives prime cost, summation of indirect cost gives overheads, that leads us to the cost card, arriving at the cost card or what we call the cost sheet. Okay, so and we're going to expand on this later on. So stay with me carefully. Third distinction is about controllability. Direct costs are controllable, whilst indirect costs are non-controllable. Direct costs are controllable, while indirect costs are uncontrollable. Now, how is that? Is that really true? Yeah. Is that really true? Uncontrollable. How is that? Is that really true? Yeah, because if we go back to my furniture business, I can decide a type of wood that I want to use. Either I want to use Wawa, I want to use Odum, I want to use whatever, plywood or what kind of wood that I want to use. But TNT, I cannot control that. Now, fuel prices, taxi is charging, Uber is charging. I can't control that. Rent, I cannot control it. Electricity bill, I cannot control it. So really, direct costs are controllable. And the reason why these are controllable and indirect are also non-controllable is about the margin that they have of the total cost. Because direct cost, okay, direct cost represents a greater percentage or a greater proportion of the total cost. Greater percentage or greater proportion of the total cost. But then indirect costs represents a small or marginal percentage, small or marginal proportion of the total cost. Any questions, please? These are the differences between direct material and indirect material that we can share our thoughts on. And that brings us to the understanding of looking at the elements of cost in terms of direct material and indirect material. Any questions, please? You raise your hand, I bring you up, or you put it in the chat for me, and I'll provide you with some answers. Okay. Now that we've looked at the elements of cost and considered the cost sheet or the cost card, the next thing we need to ask ourselves is, okay, what is classification of cost according to, there was another one, number 5, behavior, that I didn't mention. Let me bring that up. Behavior. So let me take that one as the second one. Classification of cost according to behavior. According to behavior. Okay. Now, when we talk about according to behavior, it refers to the classification of cost. It refers to the classification of cost according to how it reacts with the output level. According to how it reacts with the output level. Or respond to the output level. So that is the second thing, classification of cost according to behavior. Behavior. Now, this is where we have types of cost. And some serious issues will rise up here. So here we have what we call fixed cost, variable cost, semi-fixed cost, and then step cost. So we have fixed cost, we have variable cost, we have semi-fixed and semi-variable cost. So when we say fixed cost, what the hell is fixed cost? Like the name suggests, it's fixed. Like the name suggests, it's fixed. Please give me a moment. So when we say fixed cost, what is fixed cost? Now, like the name suggests, it is a cost that remains the same irrespective of the output level. Okay, so it refers to the cost that remains the same the cost that remains the same or remains unchanged irrespective of the output level. So that is fixed cost. That is fixed cost. Now, so here, diagrammatically, it goes this way. We can represent the fixed cost this way in a diagram. So this is our fixed cost. We have the currency here, we have the output here. And this is the fixed cost. We can put some money here. What does that mean? It means when output is 0, you will be incurring the fixed cost. Like for instance, if you want to start a business, you have to register the business. You would have to rent. You have to buy equipment. All these things are fixed costs. They remain the same irrespective of what? The output level. Irrespective of the output level. Then we have the variable cost. That is the opposite of fixed cost, definitely, right? So the variable cost. Now, the variable costs are the costs which vary or change with the output level. So it refers to the cost which vary or changes with, which varies or changes with the output level. In other words, what happens is that it is when you begin to produce that you start to incur variable costs. It is when we begin production, that is where we incur variable costs. It is when we begin production that we start to incur variable costs. So example of this includes material costs, labor costs, okay? These are all variable costs because the more you produce, the more you incur costs in relation to these. But you see, there has the idea of variable and fixed gives us another chart which we'll be using actually in the break-even analysis. So I'm going to sketch it down, but we'll use it in break-even analysis. So in break-even analysis, we're going to be using this chart there. Which goes this way. And like I said, we use it in break-even analysis. Still our currency is here. And then our output is here. Bring 0 here. What happens is that this is still our fixed cost. This is our total cost coming in at the end of the day. And we have total revenue coming in at the end of the day. Now, the point at which total cost meets the total revenue is the break-even point. Okay, is the break-even point. And so when we trace that break-even point here, it gives us what we call the break-even point in value. Then when we trace that's also down, it gives us the break-even point in units. And so we will expand on this diagram later on when we are doing break-even analysis, but it is borrowing the knowledge from the fact that fixed cost remains the same irrespective of the output level, and the variable cost really cost that we incur as the output changes or the output increases. So that is the second type of cost. But we also have some costs that are partly fixed and partly variable. Those costs are referred to as the semi-fixed or semi-variable cost. Semi-fixed or semi-variable cost. These are costs that contains both fixed components and what? Variable components. So these are costs that are partly fixed and partly variable. Partly fixed and partly variable. So that is semi-fixed cost and semi-variable cost. They are partly fixed, partly variable. Now, the question we then ask ourselves is, I'm going to expand on these in a moment. Then the last one, number 4, is going to be step cost. Sometimes we just do it in the present terms, step cost. Other times it is written in the past tense, stepped cost. So it depends. Sometimes it can also be called step up cost, depending. There are a couple of step up costs. So it has different ways. But the idea about step cost is that these are costs that are fixed within a certain given output level, but become variable when the output level changes. So these are the extra costs incurred when output exceeds a given limit or level. Now, the nature of step cost is, it looks something like this. It is fixed, become variable, fixed, variable, fixed, variable. That is why it is called step cost. Okay, so it is fixed, becomes variable, fixed, then becomes variable. That is why it is called step cost. Any questions on these types of costs before I expand on them? Any questions, please? You raise your hand, I bring you up, or you put it in the chat for me. Okay. So the question we then ask ourselves is, okay, when these are given to us, provided to us generally, there's a document. Now, we are going to go through a couple of questions right now, and you can download this document on the portal under today's video. So you go to August 2021 Zoom sessions, and if you are live and you go there right now, there is no video there, but you can see the document, the link there to click on it to download. So you can download this document on the portal under August 2022 Zoom session 1. So you can download this document there, because we are going to use this document right now to solve some questions from here under the classification of cost according to behavior. Now, most of the things here, I've already explained them, and we'll go through them again. Direct and indirect costs, I've already answered that. Fixed costs and variable costs, we've answered that. Controllable and non-controllable costs, we've answered that. I'm going to share my thought on the other ones as we continue. Now, the question we ask ourselves is, how do we separate, if we have a cost that is semi-fixed cost, that is, we have total cost, how do we separate total cost into their individual elements? So the way we separate total cost into fixed and variable is called the high and low method. So I want you to stay with me carefully here, because this is one of the key principles you're going to be using across various discussions. You're going to be using this principle across various discussions. So you want to make sure that you stay with me and understand that very well, as we're going to be using it on various other discussions. So the high and low method. Now, if you go to your documents, if you have downloaded it, let me give you some, maybe 60 seconds, or maybe just, 60 seconds. You can download it on the portal if you want to download it now. Under today's session, August 2022 Zoom session, you can download this. And on page 3, we want to start our discussion from there with some questions. So stay with me carefully. So you can see here step costs, fixed costs, and variable costs. Now, I spent time to give some examples of that because I told you I'll be expanding on these later on. So fixed costs like rents, utility, loan repayments, all these are fixed costs. Because if you take a loan, I mean, there is a certain amount you're supposed to pay every year, every quarter, or every month. So that is a fixed cost. You can't change it. Okay, you cannot change it. Then variable costs, we said they are costs that change with the output level. So over time, contracted services, travel, fuel, supplies, all these are variable expenditures or variable costs that we can talk about. Then step costs, like salaries, could be a step cost at the end of the day, inclusive of bonuses. Then employee benefits can have a step cost components coming in because if, let's say, you produce 10,000 units, you will get a bonus of this amount. But if you exceed 10,000 units, you get an additional income of Y amount coming in for you there. Then software subscription plans. Software subscription plan. Like for instance, if you are subscribing to Netflix, I mean, they have various price points, whether you want your subscription to be HD or you want full HD coming in, or there are other subscription plans where there is a certain level of outputs that we can have or benefit that we can have relating to the period under review. So these are all examples of step costs. And we are going to expand on these in a moment with the questions we have here on the high and low method. Yes, Magdalene. Magdalene, your hand is up.
Yes, sir. Sorry, please. I just wanted to know where you are getting the material from, because I don't think I see it in my.
Not in the mobile application. No. In the mobile application, you cannot see it. So on the main website, so when you go on the website under today's lecture, August 2022, section 1, there is no video there, but there you will see the link there. When you click on it, you'll be able to download it.
Okay, thank you, sir.
All right. So let me give some maybe 2 minutes so that everybody will be able to get that, because we are going to go through that and solve questions from there. So 2 minutes quickly. Let me see if we have some thing coming in on YouTube. Isaac Note Okran said, please, I want to join the Zoom meeting. Yeah, you send her on WhatsApp or you enroll in our full course online, then you can join the Zoom meeting. Timothy said, Nhyira, is management accounting the same as cost accounting? Management accounting is the senior brother of cost accounting. Okay, so management accounting is more advanced than cost accounting. Squenage said, hello, sir. Hi, Squenage. Abraham O. Colley said, I have a question, please. Yeah, you can ask. And we go there. Madeline, have you seen it now? And now that's okay. Have you seen it now? So that okay. So high and low method, how do we split costs into the various components? So I'm just referring to the document, the formulas are there. I'm not going to rewrite it. We're going to just solve the questions to explain the principle. So the way we split semi-variable cost or semi-fixed cost into the fixed component and variable component is to use what we call the high and low method. Please, Understanding this concept is crucial for you because you will need this knowledge in budgeting. You may need this knowledge in variance analysis, and you may need this knowledge in preparing the cost sheet or the cost card if the examiner throws any question like that at you. So how do we do the split? Step one is to find the variable cost per unit. Now, how do you find a variable cost per unit? Simple. Variable cost per unit under the high and low method is simply your total cost at the highest activity level minus total cost at the lowest activity level divided by the highest activity level minus lowest activity level. That is how we get a variable cost per unit. So there is an illustration here. Let's pick that illustration, then we go through the steps one after the other. Very simple illustration. In July, activity level is 4360. In August, activity level is 6400. So if you realize, you could see that the examiner said, what is the total cost if we produce 3,000 units? What is the total cost if we produce 3,000 units? So solution, what did we say? We first need to find a variable cost per unit. So we say a variable cost per unit equals the maximum or the highest total cost at the highest maximum level, and then total cost at the minimum or lowest level. So we can say maximum total cost minus minimum total cost divided by maximum output level minus minimum output. So if we go back to the question, you can see here that the maximum cost is 31,400. Minimum is 26,810. Please, I need fastest hand to punch these things out for me. So 31,400 minus 26,810 divided by 6,400 minus 4,360. So someone should give me. Sorry?
2.25.
All right. So 2.25. Please note that one key assumption you have to take with you from now till the day you die is that variable cost per unit remains the same irrespective of output level. And you will need this everywhere you go. So variable cost per unit remains the same. Per unit remains the same at all output level. At all output levels. So that is an assumption we use in management accounting. And so make sure you keep that in your mind. So that is the first step. We determine the variable cost per unit. Then step number 2, we find the fixed cost. How do we find the fixed cost? We can use the total cost at the maximum activity level or the higher activity level, or the total cost at the lower activity level. Whichever way we go, we will be right. But let's use the higher activity level. So let's find fixed cost. You know that total cost equals variable cost plus fixed cost. Stay with me carefully. It means we are looking for fixed cost, and fixed cost will be equal to your total cost minus variable cost. Total cost minus variable cost. So the question we ask ourselves is, How do we look at it? So we will say at high output level, so at high output level, what is our total cost? It's up here. At high output level, our total cost is 31,400. So we will say that at high output level, our fixed cost will be equal to 31,500 minus variable cost. Now, how do we get a variable cost?
Please,
We have
31,400.
Right. Thank you. 31,400. So how do we get a variable cost? We have calculated a variable cost per unit to be 2.25. So we multiply that by the highest output level, which is 6,400. So we're going to have 31,400 minus, what do we have for this guy? 2.25 by 6,400. What we got? Getting like 14,400. I don't know if I'm right.
Yes, 14,400.
14,400. Okay. So we subtract that.
$17,000.
$17,000. So that is how we split the cost into the fixed components and the variable components. But we have not answered the question yet, because the question said, what is the total cost of 3,000 units? So if we produce 3,000 units, what is our total cost? That is the question the examiner is asking us. So let's figure out that. So we will say at 3,000 units, our total cost will be equal to fixed cost. Remember, we said fixed cost remains the same irrespective of the output level, right? So whether we are producing 6,400 or we are producing 3,000, the fixed cost is still going to be the same. So the fixed cost is going to be 17,000. Then we add the variable cost. Remember, I told you that the variable cost per unit remains the same irrespective of what? The activity level. Hence, to get our variable cost, it is going to be 2.25 times the output we are producing, 3,000 units. Right? So our total cost becomes 17,000 units plus what we got on this?
6,750.
6,750. Then we add the two up.
23,750.
Right. So this is the answer to our question. What is the total cost of 3,000 units? Any questions, please? Any questions? Any questions? So that is the idea. Step one, get your variable cost per unit. Step two, calculate your fixed cost. Then step three, you now contextualize to calculate the cost that is available. But this is just a starting point. What if there is step cost built in the system? How do we deal with that? If there is step cost built in the system, how do we deal with it? And I want you to pay attention very carefully on this one. And that is what leads us to the final question on page 5. High, low with stepped fixed cost. High, low with step fixed cost. I want you to pay attention to this question carefully to see how we're going to be structuring this question out. It says, an organization has the following total cost at 3 activity levels. 4,000, 6,000, 7,500. Total costs are given as $40,800, $50,000, and then $54,800. Variable cost per unit is constant within this activity range, and there is step up of 10% in total fixed cost when the activity level exceeds 5,500. Be careful. Be careful. Remember, I told you that one of the issues in management accounting is understanding the grammar, the structure of the question, having a deeper comprehension. And stay with me carefully as we try to understand this question pretty well. It is variable cost per unit is constant. If the examiner that didn't tell us, we know that variable cost per unit is constant. Then what is going to be happening then is that we are going to bring in, the examiner said, and there is a step cost of 10% in the total fixed cost when the activity level exceeds 5,500. When the activity level exceeds 5,500. Required. What is the total cost at an activity level of 5,000 units? What is the total cost at an activity level of 5,000 units? So that is a question the examiner is asking us. Well, how do we deal with it in that particular case? Now, as always, it's high and low method. So we need to start with high and low method, definitely. But you have to be careful here. You have to be careful. You see, yes, this is the highest. Okay, this is the high. I mean, we cannot ignore that. Then this is the low. We cannot ignore that. Okay. The red is the high. The green or lemon green or whatever the heck that's green, whatever the heck, it's low. But there is a caveat in the question that there is a step up cost of 10% in the total fixed cost when activity level exceeds 5,500. When activity level exceeds 5,500, it means that the fixed cost issue we are talking about here comes in with a step cost when the output level exceeds 5,500. So anything below 5,500, the fixed cost here there is going to be different. It's going to be different. So for us to determine our variable cost per unit here, we will use the output level at 6,000 and the output level at 7,500. Because you cannot go down to 4,000 because the step cost starts at 5,500. So even though the lowest is 4,000, 40,800, we will not use that in the determination of our variable cost per unit. Instead, we will use the 6,000 at 50,000 as our lowest cost because of the statement of the fact that the step cost of 10% kicks in when the level of activity exceeds 5,500. Does that make sense? If any questions, you raise your hand, I bring you up, or you put it in the chat for me. So the variable cost per unit here is going to be, yes, certainly your maximum 54,800 will come. Minus $50,000. Like I said, we would deal with the output level that is above the 5,500 divided by the units, 7,500 divided by 6,000. Hey, just 7,500 and then 6,000. What do we have if we should punch these out? So that will be 4,800 divided by 1,005.
3.2.
Right. So $3.2. So that's our variable cost per unit. Once we get a variable cost per unit, we need to find out what is the total fixed cost when our output level is above the 5,500. So we kick in the total fixed cost. We bring in the total fixed cost above 5,500 units. Above 5,500 units. And how do we do that? We know our total cost at the maximum level already, and that is 5,800 minus at the maximum level, it is 7,500 times 3.2. You remember that, right? Because we are calculating fixed cost at maximum. Okay, fixed cost at maximum. Sometimes I need to repeat all of these things. So fixed cost at maximum. So if we should work this out, this is 54,800 minus 3.2, 7,500.
24,000.
Right. So that should give us 30,800. 800. So that is our total fixed cost at the maximum level. But you got to be careful because there is a step cost built in the question. Stay with me carefully. The question says that there is a step cost of 10% in the total fixed cost when the activity level exceeds 5,500. So since this is total cost at output total fixed cost at output above 5,500, the question we need to ask ourselves is, what is total fixed cost below 5,500 so that we can remove the step cost component from the total fixed cost? Let me take that again. The total cost of 30,800 is the total fixed cost when output level exceeds the 5,500. But the question we must ask ourselves is, what is the total fixed cost when the output level is below 5,500? So that we can remove the step cost component from the total fixed cost. So how do we do that? Simple. So total fixed cost below 5,500 units. How do we do that? Look at it. It says that the step cost is 10%. If the step cost is 10%, then we are looking for the fixed cost. So it means that the total fixed cost you see here, 30,800, is actually the fixed cost plus 10% of step cost, which means it becomes 110%. So if we are looking for the fixed cost below 5,000, that is simply going to be the 30,800 multiplied by 100 divided by 110. What do we mean by that? Like I said, this 30,800 here is our base fixed cost plus 10% of the step cost. Sounds good? The base fixed cost plus 10% of the step cost. So that means the base fixed cost is 100%. Then the step cost 10%, it becomes 110. So if you are looking for the base fixed cost, which is the fixed cost below 5,500, exclusive of the, how do we call it? The step cost, then we will go this way. Now, how do we arrive at this? This is the KG2 approach. The 30,800 represents 110. So how much will 100% be? Okay. Does that make sense? In my KG2 class, the 30, now if you don't know that the 3800 is 110%, then you don't understand the English. Then you have to go back and learn English again. Okay, so the 3800 represent 110. So how much will 100% be? So you do the cross multiplication, and that is how come we are getting what we are getting here at the end of the day. Does that make sense, please? Any questions? Any questions, please? And you can punch that out for me. Let's see what we got there.
28,000.
28,000. Any questions? Everybody good so far? It's the language of the question, the way the English is structured, that determines the way we are answering the question. Yes, Oxbeth.
Yeah. Yes, sir. So please, can you compute the fixed cost below the 5,500? Then you take 10% of it and add back, or you take 10% so that that one will represent the increment. Is it possible?
Come again.
To do that?
Can you?
Is it
come again?
possible we can compute fixed cost at below 5,500? Then you take 10% of that fixed cost as the step cost and add it. Is it possible we can do that?
Relax, because what we just calculated here is the fixed cost below 5,500. That's what we just calculated. So if you say, does it mean that we will skip this one here?
Yes.
Is that what you are saying?
Yes. So that we wouldn't calculate the fixed cost above 5,500. Then you go straight forward to calculate fixed cost below 5,500. Then you take 10% of it and add back.
Okay. That way, it will not give you the answer that is required because of the structure of the question that is given to us. Because if we go by that approach, that means we will look for probably the minimum. And if we are working at the minimum, that will be 4,000. Are you getting it? And if we work at 4,000, you wouldn't be able to get the answer that you are supposed to get. So in the context of this question, we cannot go the reverse. We need to calculate the total and then bring it back instead to the base.
Okay, thanks.
All right. Any other questions, please? Any other questions? Now, we've not answered our question yet, too. We are still looking at this at the end of the day. The question said, what is the total cost at an activity level of 5,000 units? So if the company wants to produce 5,000 units, what's the total cost? Now we know our base fixed cost as 28,000. We know our variable cost per unit as what? 3.2. So now we can calculate our total cost, which is the answer to the question. So total cost at 5,000 units. So what do we have? Total cost equals our base fixed cost, which is an amount of $28,000 plus the variable cost, which is going to be, what was our variable cost per unit? 3.2 times the 5,000 units. Let's punch that out and let's get some answers coming in.
28,000 plus 16,000 equals to 44,000.
So that's our total cost if we should produce at 5,000 units. This is the answer to the question if we have step costs being built into the system. Any questions, please? Any questions? Okay. So that is a concept of splitting costs into the fixed and variable components, and splitting costs when there is step, and then what? When there is step cost inbuilt into the system. And there is step inbuilt into the system. You can try your hands on the second question here, illustration 2. You can try your hands on that and send it up for me to check for you. So you can try your hands on illustration 2 here. So that is your test assignment. Try your hands on it and send it over. Please know that all assignments will be sent via email. The email address is assignments. It's going to be posted on the page. assignments@NhyiraPremium.com. assignments@NhyiraPremium.com. We're going to post it. Let me see if I can put it on the page as well. Yep. So that has been posted on the page. So you try your hands on it and then you send it over so I can check for you. So that is how we split cost into 8 fixed components and variable components. And that is classification of cost according to behavior. But we are not done yet. Okay, we are not done yet. So let me go back to my slide. So if you look at the slide we have here, we mentioned that we can classify cost according to the nature, according to the behavior. We've looked at the nature a little bit. We've looked at the behavior. That is where the high and low method come in. We've looked at controllability. Production has to do with classifying cost into production cost and non-production cost. So all the costs that relates to the production of the goods will be production cost. Then all other costs that relates to selling, distribution, warehousing will be non-production cost. Then classification of cost according to function is where we classify cost according to the departments that incur the cost. So this is where we have like production cost, sales overheads, selling and distribution overheads, finance overheads, because we are classifying the cost according to the functions. We are classifying the cost according to the functions. So now we've dealt with all of these items, but we need to share our thoughts, because generally we said it is either cost is a direct cost or it is an indirect cost. So how do we account and then prepare our cost sheet or cost card at the end of the day? So preparation of cost card or cost sheet. Now, I have already given you the pro forma of the cost card or the cost sheet. We've looked at that already, but we're going to be expanding, we're going to expand on that a little bit here. Now, if you are preparing the cost card or the cost sheet, there are 2 schools of thoughts that can be used. We have what we call the marginal costing. The marginal costing, and then the absorption costing. Please, the knowledge of marginal costing and absorption costing is crucial. You will need this in short-term decisions. You will need this in variance analysis. You will need this in budgeting and budgetary control. So make sure you understand the explanation that is about to go down between absorption costing and marginal costing. Very important. So stay with me carefully, because if you fail to understand what is marginal costing, what is absorption costing, short-term decisions, you will struggle. Variance analysis, you will struggle. And budgeting, you will screw it up. So let's start with marginal costing. The idea about marginal costing has to do with the key thing about it. So I'm going to do it alongside with absorption costing so that you understand the thoughts that will come in. So absorption costing, marginal costing will be on side by side. Then we go. Now, the concept of absorption costing is that its objective is to maximize contribution. So the objective of marginal costing is to maximize contribution. Is to maximize contribution. That's the objective of marginal costing. So the question we then ask ourselves is, what then is contribution? Contribution is your selling price or sales minus variable cost. Your selling price minus variable cost. Please note, when we say variable cost here, we mean both production variable cost, production or factory variable cost, and non-production variable cost. Very important, both production and then non-production. So contribution equals selling price minus variable cost. Our objective is to maximize contribution. Contribution is selling price minus variable cost. Why is that so? Why is that so? Because under marginal costing, cost can be classified into fixed and variable. So in marginal costing, that is the third point. In marginal costing, cost is classified into fixed cost and variable cost. And you have to note that the fixed cost is considered as period cost and written off against contribution. The fixed costs are considered as period costs and written off against contribution. And written off against contribution. That is the idea about this. And I'm going to expand on this in a moment for you to understand exactly what is going on. So in marginal costing, we are saying that our objective is to maximize contribution. In marginal costing, the contribution is selling price minus variable cost. Please note, the variable cost is both production variable cost and non-production variable cost. Why do we do that? Because in marginal costing, cost is classified into fixed and variable, and fixed cost is considered as period cost. Hence, it is written off against any contribution that a company incurs for the period under review. Now, what does that mean? It means that under marginal costing, closing inventory is valued at marginal cost. So in marginal costing, closing inventory is valued at marginal cost. meaning at factory variable cost of production. At factory variable cost of production. That is the idea about marginal costing. Our focus is on contribution. We split all the costs between fixed and variable, and boom, we are able to arrive at our net profit, and we value closing stock at marginal cost. Any questions, please? You raise your hand, I bring you up, or you put it in the chat for me. Like I said, understanding of this is very crucial. Understanding of this is very crucial. Very, very crucial. So what does that mean in context? This is what it means. So if I take you back to our ebook, let me see if I have my cost card or cost sheet here. Do I have it here? Let me see. Because I don't want to write it. So let me see if it is here, which it should be, so that I will just refer to it for you. Then I don't have to go through the, yep, it's here. Thanks be to God. So in your ebook on page 54 in the ebook, the format is there because I don't want to write it again. I don't want to write it again. The format is in your ebook. So look at it. When we are preparing the profit statement as a whole, what is going to happen is that we bring in our sales, we bring in our variable cost of sales. So you bring in all your variable manufacturing costs, then you get your production cost here. Then you less closing stock. Remember, closing stock is valued at marginal cost. We just said it a moment ago. Closing stock is valued at marginal cost. So we less the closing stock. And that gives us the marginal cost of production. That gives us the marginal cost of production. So that is the issue there about that. That is the marginal cost of production. Because in marginal costing, only variable costs are considered when we are determining production cost. If we want the cost of production, factory cost, in marginal costing, you deal with only variable costs. You deal with only variable costs. Very important. Very important. So once we less that marginal cost of production from the sales figure, we get what is called the factory margin. Factory margin. Then if there is non-production variable cost, because remember I told you that variable cost is both production and non-production, right? So if there is a non-production variable cost, we less it. That'll be variable administration overhead, variable selling and distribution overheads. So when we subtract that from the factory margin, that is what is going to give us the, contribution. That is going to give us the contribution. So that is how we prepare the profit statement, the first part of the profit statement in arriving at the contribution. Please note that if in the question we don't have variable non-production overheads, then the factory margin will be the same as contribution. So if we don't have non-production overheads, assuming these guys are not there, then the factory margin will be the same as what? The contribution. I hope that makes sense. The factory margin will be the same as the contribution. Then we less all our fixed costs. Because remember, what did we say here? we said fixed costs are considered as period costs and they are written off against what? Contribution. So you bring all your fixed costs, both production fixed costs and non-production fixed costs. You bring all of them, you subtract it, and that gives us the net profit or loss. This is the profit statement when it comes to the marginal costing. Any questions, please? Any questions? Okay. We good. But marginal costing doesn't give us a real or a true picture of the organization, because even though it is simple, you don't say, oh, my cost of production is only variable cost. How about the rent you paid? How about the machines you used? Okay, how the fixed cost you incur, how about them? So the marginal cost is limited and has disadvantages. And nuntina, the absorption costing is there. Now, with the absorption costing, what we are looking out here is that it is going to be like our typical profit statement at the end of the day. So here, what happens is that production cost or cost of inventory is valued at full factory cost. So the first thing you must know here is that inventory is valued at full factory cost. That's the first thing you must know. When we say at full factory cost, it means we include both the production, both fixed factory costs, both fixed and variable. Both fixed and variable. For that reason, what happens in absorption costing is that we would have to absorb overheads. So overheads are absorbed into production activity or products, which means that we would have to calculate the overhead absorption rate. And the overhead absorption rate calculation, we're going to get into that in a moment. And that is going to be the issue about the total budgeted overheads divided by the total budgeted activity. So we would have to absorb the overheads. Now we'll deal with what is absorption of overheads in a moment, and you will get to understand exactly what that is in a moment. So just stay with me. Now, because we are going to be absorbing the overheads, what is going to be happening here is that there will be over absorption of overheads and under absorption of overheads. So there is always over absorption of overheads and under absorption of overheads. Now, what do we mean by over absorption of overheads and absorption of overheads? What exactly do we mean by that? We're going to be explaining that in a moment, and you will see what it is that we mean by that. So in absorption costing, we don't split costs. If it relates to production, production. If it relates to non-production, non-production. But we value inventory at full factory cost. And this is in line with IAS 2 inventories. Because in IAS 2, We value inventory at full factory cost, not at marginal factory cost under marginal costing. So actually, marginal costing is not in line with IAS 2. It is the absorption costing that is in line with the IAS 2. That is in line with the IAS 2. Based on that, our profit statement under the absorption costing looks like this. And that is in page 58 of your book. And I'm going to explain it to you, don't worry. And it looks like this. So we bring in our sales, but this time around, we bring in cost of sales. So as you can see, we bring both production and non-production, variable and fixed production cost. Then we will value closing stock at full factory cost. Very important. Then we'll get our cost of sales. We subtract that, and that gives us the gross profit, because the absorption costing is the traditional way of preparing financial statements. The traditional way of preparing financial statements. Then, finally, we less all non-production overheads. But most importantly, we are going to do over or under absorption of overheads, which I'm going to explain to you in a moment. And then that gives us the net profit or loss. So this is how we prepare the profit statement in absorption costing and the marginal costing. And the pro forma is there in page 58 of your book. Any questions, please? Any questions? Okay. Let me bring in a slide on this quickly, absorption costing quickly, because I want to share some thoughts on absorption costing. That should be above here. Yep. There is a slide I'm looking for. Please give me a moment. Let me just get to it here. Yeah. Stages of absorption costing. And that'll be the final thing we'll look out for. And after that, we look at a question there. So stages of absorption costing. Stages of absorption costing. Now, generally, there are 3 stages of absorption costing that we must know about. We have allocation, absorption, and apportionment. Allocation, absorption, and apportionment. Just one-liner definitions, then I ran away from that. Allocation of overheads is the process of charging an overhead to a cost center or cost unit. That is allocation of overheads. Charging overheads to a particular cost center or a cost unit. That is overheads, allocation of overheads. Number 2, apportionment of overhead. When we say we are apportioning overhead, it means we are sharing the overheads between cost centers using a fair and equitable, on a fair and equitable basis. So this is what we mean. Allocation means you are charging the overhead to a particular cost center or cost unit. Apportionment of overheads means you are sharing it. Okay, you are sharing overheads between cost centers, and cost units. But the question you ask yourself is, on what basis do you share? What are the bases of apportionment? So we need to know about the basis of apportionment of overheads, because that sets the tone for us. Now, the reason why this is important is that, you see, sometimes the whole factory can incur a cost, but there are various departments within the organization. So the question we ask ourselves is, how do we share, say, electricity bill to all the departments or among the departments in the organization? How do we share water bill among the departments in the organization? We have a canteen. How do we share the canteen expenses among the departments? We have insurance. How do we share the insurance among all the departments? Because we need to get the cost for each of the departments. It is the apportionment of overheads that leads us to the preparation of what is referred to as the overhead analysis sheet. The overhead analysis sheet. So the overhead analysis sheet is simply something that is prepared to show how costs are going to be allocated. So we're going to have elements of cost, basis of apportionment, total cost. Then it's going to be splitting into the various categories. So this is just for illustrative purposes. So the format is that we will bring in the element of cost here. Then we'll bring in the basis of apportionment. How do we share, or how will we share that cost? Then we'll bring in the total cost. Then we bring in our production department. Let's say we have two production departments, 1 and 2, or production department A, X, and Y. Then we have a service department. Service department 1 and 2. So the question is, if we incur rent expenses, how do we share it? Rent overheads, okay? Only overhead, because the thing is overhead analysis sheet. So if there is any direct cost, we don't bring it here. Only overhead. So rent is an overhead. How do we share it? Insurance. How do we share? Electricity bill. How do we share? Depreciation of assets. How do we share? Canteen cost. How do we share? These are all various elements of cost, various overheads that are incurred. If we incur this cost, how do we share it among the 4 departments in the organization so that we can determine the total cost for each department for the year under review? The sharing of these overheads among the 4 departments is what is referred to as apportionment of overheads. Okay, that is what is referred to as apportionment of overheads. And like I said, there are bases of apportionment. So if you check your book on page 31, we gave guideline on some of the bases of apportionment that can be used. So a guideline is given on some of the bases of apportionment that can be used. Please know that the examiner has asked a question relating to overhead analysis before. It's a fundamental area to throw students away. So it's something that is basic as well. So let's say we are dealing with value of a machine, depreciation of a machine, insurance of machine, repairs and maintenance. We can use the cost of the machine to share as the basis. If you are dealing with insurance of building, depreciation of building, rent and rates, electricity cost, cleaning cost, you can use the floor area or space occupied to share. If you're dealing with canteen cost, you can use the number of employees. But sometimes it is unfair because sometimes you can also use the number of meals served. Because you can have a department that has only 3 people there, but the food they eat is more than a department that has 10 people, because some people, they eat a lot. All right. They like food a lot. So they will eat and go for anchor. So there are certain certain organizations using number of employees to share canteen costs will not be fair. So the company would rather use number of meals served. How many plates did you come for? Then we can use that to share the canteen costs. Okay. Then issues like electricity bill, we can also use the number of light bulbs or sockets that are being used in each of the departments in that particular case. So these are some bases of apportionment of overheads. Now, based on this rationale, you go back to your question kit, what I asked you to download, and there is a question here. Now, I'm not going to solve the entire question. I'm just going to set the tone for you, and you will complete it on your own. That's not an assignment that I will demand you on. If you do it, it's for your own good. So, because I'm just going to illustrate it, I'm not going to spend time to go through the whole thing. I don't have time for that. So you go to question 5 in the question kit, page 6, question 5, page 6. And the question there, the requirement is simple. Prepare an overhead analysis sheet, allocating the overheads to the cost centers using the appropriate basis from the information provided. Using the appropriate basis from the information provided. So let's look at it. The following information relates to the first quarter of operation for CAC Limited. So we have machining, assembly, finishing, and stores. So the question we ask ourselves is, we need to put up our overhead analysis sheet. So it's like my own is already here. So I would just have to change some things inside. So maybe what I will do is to clean this one. Then we don't have X and Y. So we don't have any production and sales department. So I'm just going to take this out. But we have 4 divisions, so that's good for me. So machining, assembling, finishing, and stores. So I'm going to put these down. So machining, assembling, finishing, and stores. Make sure you have a bigger space to write those things in full. I think our currency here is our beloved Ghana Mambapa, Ghana cedis, one of the best currencies in the world. Then we're going to start to do the workings. Like I said, I won't do all of them, okay? But I will do 1 or 2 just to set the tone for you. Then you're going to do the rest. So stay with me carefully. So we are given area of floor occupied. So it appears that, stay with me carefully, it appears that the information here are the basis of apportionment. So these are the basis of apportionment. Okay, these are the basis of apportionment. Then we go to the cost items. So you can see here they said allocated costs. Allocated costs. So we see indirect wages. Now, indirect wages, it appears that all of them have something. So we say directly allocated. So element of cost, indirect. Let's bring that down a little bit. So indirect wages. Since every department has theirs, we will say it is directly allocated. Directly allocated. So we bring in the individual figures, 16, 15, 14, 10. So 16,000, 15,000, 14,000, 10,000. You add that up, 31 plus 15, 46,000 in that particular case. 31 plus 15, Did I say 31? 20, 31, 45,
55,000.
55,000. Yeah. So 55,000. So that is directly allocated. Boom. You get that there. Next one. Indirect wages. Oh, it appears that that is also, did I say indirect material rather? That is also directly allocated. So no P on that. We're going to pick it up. So indirect wages, indirect material, sorry. So you bring the individual items up, 3,000, 2,400, 6,000, 10,000. So that's also directly allocated. So 3,000, 2,400, 6,000, and 10,000. So that is going to be 16, 19, 21, 400. Right. Also directly allocated. So no headache. Now the headache is going to start in a moment. So stay with me. Next item, rent. What will be the appropriate basis for apportioning rent? Given what we have in this question. We have area occupied, we have plant at cost, we have number of employees, we have direct labor hours, we have direct wages, we have machine hours, we have number of requisitions of store. So which of these bases of apportionment can we use to share a rent?
Area occupied. Area occupied.
Right. Area occupied. So we go and do the sharing. So rent, the total amount there for the rent is 20,000 Ghana cedis. 20,000 Ghana cedis. So we look at the area occupied. We see 12,000, 18,000 making 30,000, plus 10 making 40,000. So in total, what is going to happen is that we have 40,000 square meters. And the total overheads we are incurring is how much?
Plus stores is 2,000 though. 12,000, 18,000, 10,000, and 2,000 under stores.
Yes. So it's going to be 30. That's going to be 40,000 in total, right? Because this is an INF 40.
42.
42. Are
yes.
you sure? This is 12 plus 18.
It is 40,000.
40.
Yeah, 40,000. So what we do is that we need to calculate the rate for apportioning the overheads. So rate per square meter will be equal to the total amount of 20,000 divided by 40,000 square meter. What do we have? 20, that should be 0.5, I guess. Anamibwa. 0.5 Ghana cedis per square meter.
That's right.
Okay. So that is the rate per square meter. So if I want for machining, simple. I just bring in their figure. Their figure is 12,000. So that's going to be 12,000 square meter times 0.5 Ghana cedis. If I want for the next guy, who is the next guy? Assembling. They did 18,000. Assembling, they did 18,000 square meters. Still by 0.5. Next person, finishing, they did 8,000. 8,000 square meters by 0.5. Then stores did 2,000 square meters. And that's 0.5 as well. So you multiply up respectively, what do we have? I think that should be 6,000 in that particular case? 9,000. So 6,000, 9,000, 4,000, and then 1,000. That's it. That's it. And if you add it up, it should be equal to 20,000. So once, this is how you do the calculation. So 6,000, 9,000, 4,000, and 1,000. I come back here, come and put rent down. Floor area. Floor area occupied. Total of 20,000. So we have 6,000, 9,000. Sorry, it's here rather. 6,000, 9,000, 4,000, and 1,000. Any questions, please? Everybody good? Any questions, please? Everybody good? That's how we deal with this. Let's do one more. Let me show you one more, then you will do the rest. Next one. Business operating permit. Business operating permit. Business operating permit. What do you think? AMA. Anytime you open something, they will come after you, or KMA or TMA. Business operating permit. What will be the good basis of apportioning? Should we use floor area? Should we use plants? Should we use number of employees, or whatever the heck? What do you think? Any ideas? Business permit. Ideas?
Area.
Business permit.
Floor area.
Yes, floor area. And it is also 20,000. So it happens that it will just be the same figures. If you look at it. So business permit. We will use floor area. So it will just be the same thing coming in. So 20,000 here. Gonna have 6,000, 9,000, 4,000, and 1,000. Floor area. Sweet, simple, straight to the point. Finally, insurance. What do you use to share insurance? What would you use to share insurance? Insurance on building. Insurance on building.
Area occupied.
Yes. So we will use area occupied. I'm not going to do that for you. So this is where I'm going to leave you to do your own thing. I'm just giving you the ideas. Depreciation on plants. What do we use to share? Depreciation on plants. We have plant at cost, right?
Cost.
So we will use plant at cost. My UPS device has given me a signal like bidum. So I don't know if we doom we have closed. Sorry, it's doom so and my UPS. I don't know. It's like I hadn't charged it. I didn't forgot about it. I thought it was plugged. It wasn't plugged. So it's just giving me a sign. So if I go off unexpectedly, that means Yapon. Sorry. I'll make time for you for that. Wage related costs. How do we share that? Wage related cost. How do we share that?
Yeah. Number of employees. Number of employees.
Number of employees. Number of employees. Okay. Okay. But then there is also direct wages there. There's also direct
wages, yeah.
So which one will be appropriate and why? So which one will be appropriate and why? Which one will be appropriate and why?
So the direct wages, because that will give you that will give us the actual market in terms of wages.
Okay.
For the period.
Okay. All right. All right. Any other ideas? So Oxbert is saying that we should use direct wages to share wage related costs because it will give us an idea about the employees and the wages that we are paying. Yeah, we cannot use number of employees here. We need to use direct wages. We need to use direct wages to share this one, not the number of employees. Not the number of employees. Next one, factory administration. What do we use to share factory administration? Factory administration. Factory administration. The way we administer the factory. What will be
Number of employees.
number of employees? Why? Any reason for that? Any reason for that? So yes, we use number of employees because administration of the factory relates to the employees that have been engaged for the period under review. Insurance of plants, certainly we will use cost of plants, you know that already, in that particular case. So you're going to finish with this table, all right? The overhead analysis sheet. Like I said, you don't wait to sign it up, I'll mark it for you. If you don't do it too, that one is your own swag. So that is how we prepare the overhead analysis sheet. And that is the second item in absorption costing, apportionment of overheads. Apportionment of overheads. Any questions, please? Any questions? Okay. Then the last thing is absorption of overheads. And that is where a lot of issues will be coming up in absorption of overheads. Absorption of overheads. And we're going to be concluding around that and absorption of overheads. So what is absorption of overheads? Absorption is the process whereby costs allocated and apportioned to production cost centers are added to unit or job costs. So that is absorption of overheads. That is absorption of overheads. In another way, we can say that it refers to the charging of overheads to cost units using predetermined absorption rates. I think I like that. Let me put a one-liner up for you on that. So absorption of overheads. It refers to the charging of overheads. Refers to the charging of overheads. Refers to the charging of overheads to cost units using predetermined absorption rates. So that is absorption of overheads using predetermined rates. Now, so remember I showed you how we calculate the overhead absorption rate earlier when I was dealing with absorption costing. Is it that far? No, it's just here. I told you how we calculate the overhead absorption rate here. That the overhead absorption rate is calculated by looking at the total budgeted overheads divided by the total budgeted activity. But that is going to be breakdown on various bases of absorption. That is going to break down into various bases of absorption. So let's look at it. The overhead absorption rate, which is sometimes called overhead recovery rate, can be calculated on various bases. So stay with me carefully. The question will give you the guideline as to which basis we are using. Okay? The question will give us a guideline as to which basis we are using. And that is very important. That is very important. So we can calculate overhead absorption rate based on direct material cost. So if we are calculating overhead absorption rate based on direct material cost, that is going to be equal to your total budgeted overheads divided by total budgeted direct material cost multiplied by 100. So our answer will be X% of direct material cost. What does that mean here? I'm going to explain this to you, possibly next week as we solve a question, but listen carefully. What is happening is that, remember the definition, right? We said we are charging overheads to cost units using predetermined absorption rates. Predetermined. So the examiner will give us budget information. Okay, that budget information is what is used to calculate the overhead recovery rate. So that the answer you get from the overhead recovery rate will become the basis for determining your actual overheads to absorb. So this is going to be X% of the actual direct material cost. That's the meaning of it. So if you go to your cost sheet or your cost card, which I showed you earlier, the overhead absorption rate you calculated, if you are absorbing overheads using direct material cost, then the answer you get, if it is 10%, then it will be 10% of the actual direct material cost. That becomes the factory overheads absorbed for the period under review. I hope you are getting the idea. So the way we deal with the predetermined absorption rate is the examiner will give us budget information. Then that budget information will be used to determine the to calculate the overhead absorption rate. Alternatively, we can calculate the overhead recovery rate using direct labor cost, DLC, direct labor cost. If we are using direct labor cost, again, the numerator doesn't change. It is the denominator that will be changing. So that is going to be equal to budgeted overhead divided by the total budgeted direct labor cost. Again, because it is cost related, we'll multiply that by 100. So our answer here also will be X% of direct labor cost, which is the actual direct labor cost. That's the second basis of apportionment. Second basis of absorption of overheads. Third, overhead absorption rates using prime cost. If we are using prime cost, that is going to be the total budgeted overheads divided by total budgeted prime cost times 100. Again, this is going to be equal to X% of prime cost, which is your actual prime cost. So that is the first three bases for calculating the overhead absorption rate? It depends on the question and what you will use. It depends on the question and what is supposed to be used or what we are supposed to use. So either we are using direct material, direct labor, or prime cost, but that is not all. By default, stay with me, overhead is absorbed using direct labor costs, direct labor hours in the absorption costing. So in absorption costing, the default way of absorbing overheads is direct labor hours, so that the overhead absorption rate will be equal to the total budgeted overhead. Like I said, the numerator doesn't change, divided by and this is per direct labor hours. So direct labor hours divided by the total budgeted direct labor hours. What does that mean? It means that here our answer will be X Ghana cedis per direct labor hour, the actual direct labor hour. Are you getting it? X Ghana cedis. So the answer you get here will be whatever, maybe 5 Ghana cedis per the actual labor hour. 5 Ghana cedis per the actual labor hour. But then we can also use machine hours. So overhead absorption rate using machine hours. Again, the numerator doesn't change. So total budgeted hours. So total budgeted overheads divided by the total budgeted machine hour or machine hours. So our answer here will be equal to X Ghana cedis per machine hour. Again, it is the actual machine hours. It is the actual machine hours. That's very important. That's very important. Then the last thing I will share with you is production unit. Sometimes we can absorb the overheads using the production units. If you're absorbing the overheads using production units, again, the numerator doesn't change. Total budgeted overheads divided by the total budgeted production unit. So here our answer will be X Ghana cedis per production unit. X Ghana cedis per production unit. Again, you're dealing with the actual production units. These are the common 6 bases of apportionment of overheads. The question is, when do we use what? Stay with me carefully. Where outputs can be measured, can be readily measured, or are readily measurable, then we absorb the overheads using production units. So if outputs can be measured reliably, can be numbered, counted as production is done, then we may absorb overheads using production units. If the company uses a capital intensive production system, then they may absorb overheads using machine hours. So meaning they use a lot of machines than human effort. So if they use capital intensive production system, they may absorb the overheads using machine hours. If the company uses a labor intensive production system, then they may absorb the overheads using machine hours. So if outputs can reliably be measured, the entity may use production units. If the entity uses a capital intensive production system, then they may absorb overheads using machine hours. If the entity uses a labor intensive production system, they may absorb the overheads using the direct labor hours. If none of these guys can be reliably available, then they will go to the cost and use any of the cost items, direct material, direct labor, or prime cost. These are the 6 bases of absorption of overheads. Any questions, please? Any questions, please? Any questions? Okay. So when we absorb, when we do these calculations, then we are going to get the overhead that is absorbed based on the overhead absorption rate. Then we will compare that with the overhead that is actually charged. So we look at the overhead that is absorbed based on the calculation we did. Stay with me carefully. This is a very critical thing that I'm about to say, over and under absorption of overheads. When we do this calculation, we are absorbing overheads. So in our absorption costing, we are going to be absorbing overheads. But then what we absorbed may be different from what we charged. The difference between the two is what gives us over absorption of overheads or under absorption of overheads. What does that mean? So if your overhead absorbed, stay with me carefully. If your overhead absorbed, okay, is greater than the actual overhead incurred or charged, or incurred, then we say overhead is over absorbed. So that is called over absorption of overheads. So we say overhead has been over absorbed. Because when you are preparing the cost cardinal, what you would take there is the absorption. So you put a figure there that is greater than the actual overheads that the entity incurred during the year or is expected to incur during the year. So it means you have overabsorbed overheads. If you have overabsorbed the overheads, that means you have overstated the cost and you have reduced your gross profit. So if you're in the profit statement, you add it back to gross profit. So we add back to gross profit if we are in the profit statement. But if we are in the cost card, if we are preparing the cost card, then over absorption of overheads will be subtracted. So we subtract from the total cost. And this is if we are in the cost card. Any questions, please? Any questions, please? This is one of the most important things you must understand. if your calculation you did, the figure you got is greater than how much the entity actually incurred for the year or is expected to incur for the year, that means you have over-absorbed. So if you're in a profit statement, because you over-absorbed, you add it back to the profit statement because your gross profit has been reduced because your cost is higher. But if you're in the cost sheet, you have overstated your cost, so you subtract it from the cost. The reverse is true. Under absorption arises where the overhead absorbed, what you included in your cost sheet, is less than the overhead that the entity incurred or is supposed to incur in that particular case. Overhead charged or incurred. That is it. When this happens, that is under absorption of overheads. And if there is under absorption of overheads, it's just the flip side of this. It's just a flip side of this. Let me just copy it and take it to the same page and I'll change the things. It's just the flip side of this. So what happens? In profit statement, since you undercharge, that means you have overstated your gross profit because you have reduced your cost. So you subtract from the gross profit. Subtract from gross profit if you're in the profit statement. Then we add back to the total cost if we're in the cost sheet. Any questions, please? This is what we mean by over absorption of overheads and under absorption of overheads. And that is the difference between marginal costing and activity-based. Absorption costing. Sorry. Yes, Abeku.
Sir, I want to ask, so the overheads charged, or incurred, will you be given in the question?
Yes, it will be given.
Or you have to calculate for it?
No, you may not have to calculate for it. It will be stated or given in the question that every year or every quarter, the entity is expected to incur this cost or the entity incurs this cost. So it will always be given to you. You may not have to calculate it. The only place that you will calculate it is when, let's say it is given for a year and you are doing the profit statement for 6 months or for every quarter, then that annual thing would have to be splitted into semi-annually and quarterly, but it will be given to you and you will compare that with your calculation to determine the over or under.
Okay, thank you.
All right. Any other questions, please? Everybody good on that? Okay. All right. So thanks be to God. I'm going to conclude around here today. Thought my system will not carry me, but it has brought me to the end. Thanks be to God. God willing, next week, we're going to solve questions. So practice questions on the following: marginal costing, absorption costing. Then we'll look at activity-based costing. After that, we will go to ethics and discuss ethics briefly. Then I'm going to jump all the way up to short-term decisions, starting with relevant cost analysis. So next week, these are the things we're going to be looking out for. So we'll solve a question on marginal costing and absorption costing. Then we'll go to, activity-based costing. Then we'll discuss ethics. Then I'll come to relevant cost analysis. So you can go through them and have some idea even before we come next week. If you go to the question kit, next week, the question we're going to be solving will be this question. So you can try your hands on it even before we come next week. Let me see. This one question, the question on page 12, the last page, that is what we will be solving in class. I think it's a fair question. Yeah, the question 10. So you can try your hands on it. Don't send it to me. Just try your hands on it. And next week when we solve it, you just compare it with what you did to see if you did well or not at the end of the day. So this is introduction to management accounting. These are fundamental issues we need. These are all level 1 issues. They are not in your syllabus. So if you check your management accounting syllabus, everything we've discussed today is not there. But you cannot go to what is in your syllabus and start talking about short-term decisions, variance analysis, absorption, budgeting, if you don't know these foundations. That is why I have to use today and the session to give us that foundation so that from next week, as we begin to dive deeper into the ocean, people will not be drowned and I wouldn't have to be picking you up in that case. So that is it about that. I'm going to conclude around here today. And God willing, next week, we will continue with our discussion. Same time, like I said, we'll solve the questions on marginal and absorption and then go to activity-based, spend time on ethics. Then I'm taking you straight to short-term decisions because I'm going to ensure from the sixth week, we're going to start solving questions. So by the 6th week, I want to ensure that we have covered critical areas of the syllabus. So that is why I'm going to go in that manner. So I'm going to, from ethics, I will jump straight up to short-term decisions. I won't do models of evaluation now because those are reading areas. I'll direct you to read. Later on, I'll go through them with you. But I will go straight to short-term decision, which is an area that requires a lot of time, and we'll treat the various things there. Then we'll go to investment appraisal, we'll do variance, we'll do budgeting, then we are heading home gradually. So that is how we're going to be designing the program and going in the next 12 weeks. And we hope that you will be able to go along with us very well like that to pass the examination. So that's it. Yes, Abdullah. Bra Abdullah Baba Al Hassan. Ndra unkwan di usala. Yes, Abdullah, your hand is up. And a mistake.
No, I'm saying you should once again you should give us the process to download the ebook. I didn't get quite well.
Okay, so when you go on the website and you look at the courses,
website, is it the Nhyira Premium?
Yeah, .com, the main website.
Yes.
Then you sign in. Since you sign in with your email and password, then you go to your courses. So once you go to your courses, you will see the courses you are enrolled in. Then you click view or read.
Yes.
Then you go to course content, courses content in the middle. Then you scroll down, you will see August 2022. So in August 2022, currently you will see orientation and then session 1. So the session 1, that is where the content is that you can download. But the ebook itself is on the first video when you open the course, the very first video when you open the course.
Okay. All right. Thank you, sir.
All right.
Thank you, sir.
Okay. Yes, Seth, you want to say something? And I encode that. Okay, so that's it. I will catch you same time next week as we continue with our discussion. Good night and bye-bye.